This past week was a huge week for mortgage rates and could be the catalyst for rates dropping by as much as 1% over the next few months. And here's why. Let's start with the fact that the Fed refused to lower the rates in the middle of last week, citing that the labor market was strong and they wanted to wait and see what type of effect the tariffs would have on inflation. But for the first time in 33 years, there were two voting members that actually voted against the Fed chairman's recommendation. So there were two voting members that wanted to lower rates. And that was the first time that many voting members went against the Fed chair in 33 years. But the real jaw dropper was the jobs report that came out on the first of the month. So every first of the month, there's a job report that comes out. But this job report is based on a survey. So it's an estimate of how many jobs were created for the month of July. It was reported that 77,000 new jobs were created in the month of July, which missed expectations. The expectations were 110,000. That's a sign that the job market is slowing. But even bigger than that was the revisions for May and June. So to rehash, the jobs report that comes out, it not only estimates how many jobs were created the month before, but then reconciles the actual number of jobs that were created the 2 months prior. And what the reconciled numbers for May and June came out that of the roughly 300,000 jobs that were created in May and June, 260,000 of them were overstated, meaning that there weren't 150,000 jobs created in May and in June, but mere 20,000 jobs created. Now, this wasn't the first time that estimates missed by a lot. It's actually been happening for the last year and a half. As many as 70, almost 80,000 jobs a month this year never happened. And it was just as bad last year. This is a big deal when these job reports miss on estimates, because the financial markets move off of these initial job reports, but they don't really react to the reconciliation reports 2 months later. So it's really important that these job reports at least get close or closer than they have been over the last year and a half. If the estimated job reports had come out somewhat accurate to what the reconciliation reports would be, or even understated jobs, we would probably have interest rates of about 0.5% lower than what we've had over the last year and a half. The end result of these poor estimates over the last 20 months by the BLS, or Bureau of Labor Statistics, is that the head finally got fired, and there appears to be a real concerted push to come up with a better estimate so that the markets react how they should, based on actual numbers, not just these estimates that have been so off for so long. This also is going to force the Fed's hand in having to lower the rates, because at this point we have a very anemic job growth and have for quite some time. And the only way to sort of help that is to lower the interest, is for the Fed to lower the Federal fund rate. Now, again, that's not, the Fed can't lower mortgage rates, but the Federal fund rate certainly has an influence on mortgage rates. So moving forward, we can expect lower rates, and we've already seen a nice little improvement on Friday, but I expect those improvements to continue over the next several months. So it seems like we're finally heading the right direction as far as interest rates goes, and we can expect lower rates over time. And I think we can see rates in the 5s by the end of the year.